Good afternoon and welcome to the Wealth of Advice market update on Friday the 17th of July 2020. So another week passes where we've continued to assess what's going on in world investment markets, and this week we spoke to T. Rowe Price, a fund manager, on Monday. T. Rowe Price are one of the largest US fund management groups. We have around about £14 million of our clients' money invested in two of the funds that they offer. So they are very important in respect of our clients, but in the US, as I say, they are a very, very major player. The question that was asked to them was, where are markets likely to go from here, which I'm sure is a question that everyone who's watching this presentation will want to know the answer to. So T. Rowe Price's view on this was they said that they think there is definite potential for a lot of growth in what they call risk assets, so stocks and shares and bonds. It is going to be difficult from here going forward because the impact of the stimulus that was put in at the beginning of the crash will gradually wear off. And we saw this during the global financial crisis. As time went on, the impact of the government stimulus and impetus would wear off. Now, I was watching I think it was Bloomberg yesterday, where they were talking about this in America. There's so many million people who are on government handouts from the stimulus package that they brought in March. They're going to come to end in the next few weeks. So it'll be interesting to see what governments around the world are going to do when economies aren't picking up maybe as they want to, or the threat of more redundancies or job losses looms. Obviously in the UK, we saw our Chancellor offer the bonus where employees will receive money in January 2021 if they've kept employees employed up till then. This week saw the start of what they call corporate earnings season in the US, and that's where big companies come to the market and announce what their earnings have been like. So clearly we're going to see a little bit more volatility in the coming days and weeks if you get a big company who's going to announce its earnings are either worse or better than expected. You are seeing mixed stories in the UK. I was reading that inflation was positive during the month of May, which is definitely a positive thing for markets because it shows that people are purchasing goods and asset prices are increasing. So we certainly want to see more of that. Obviously not too high, we don't want inflation to run away, but we want to see some of these positive news stories coming through that companies may be doing better than expected. So the next question that was asked to T. Rowe Price on Monday was, is the stock market recovery sustainable? The obvious thing that they highlighted was the fact that governments reduced interest rates again in March into April to fuel the stimulus, to fuel the market growth. Clearly they can't do that again. You can't reduce interest rates any further or else they'll go negative. So we won't see this boost again. Central banks have been pushing liquidity into the financial system. Again, spoke with someone this morning and their description of this was banks are inventing money. That was a client's view on how he understood the system to work. Well, yes, new money is produced, so the money supply increases, but ultimately that money is used to purchase government bonds. It's used to purchase other risk-based asset corporate bonds they purchase in America, and eventually that will go into the stock market. So that will provide a sustainable recovery, but obviously it can't be the only factor. You've got to have corporate earnings coming through, and you've got to see the markets feel that it's a safe place again, feel that companies are going to do well and come out of the other side. So if the virus were to continue, and this is the worrying thing when we see the numbers of new infections in America, if the virus continues too long, then the recovery could be unsustainable. Clearly, if that doesn't happen, we get a vaccine or people start to isolate more. No, I think in one state across there, they've locked up, not total lockdown, but they're locking it down again. I know in India, they've got big problems with the amount of infections across there. Australia, we saw certain parts of Victoria getting locked down again. So if regional countries, so to speak, around the world in different regions are going to lock down and reduce the infection rate, and then they can keep their economy going at the same time, then maybe this recovery is sustainable. And as I say, I'm certainly positive that we will see positive numbers towards the end of this year, and for the reasons I mentioned earlier, the market should continue to rise into 2021. So earlier in the presentation, we discussed banks printing money and quantitative easing, which is the increase of money in the overall money supply of an economy. There is people out there who will worry that if you drastically increase the money supply, that will result in hyperinflation, where prices of goods will just increase and increase. People who are a lot older than me may remember back in the 70s and 80s when there was high inflation. High inflation comes often with high interest rates. It's not a good thing and not a good feel. In some South American countries recently, you've had hyperinflation where the price of goods will double in a very short period of time. So most established economies around the world will try and set an inflation target. And what this graph that you can see now is showing is what inflation rates have been over the last decade. They haven't really been too high. The 2% rate that most central banks will try and achieve has pretty much been achieved. It's alarming that the German rate that you can see at the bottom there, the orange line, has now gone very negative to the 2% target, and the UK is slightly above it, which is acceptable. But the oil price coming down is very deflationary, and that's good. Oil price dictates the cost of energy and the cost of lots of other things. Other big ticket items that you might purchase and think about that you've bought over the years, the cost of computers, the other technology items, they've come down. If you think how much it cost 20 years ago for a hi-fi system or for a computer or a big TV, compare that to now. We often feel like on some of the sales that they're giving these items away, and that's because they're made in mass production, so that brings prices down. So that's often a good thing. So inflation in certain respects is healthy, and also deflation in certain respects is also healthy. And what a central bank will try and do is keep a lid on that. So printing money, as what the government appears to have done in the last few months, is not such a bad thing. And what we're all hoping is that ultimately ends up being reflected in asset prices, and the value of the funds and the stocks that you invest into will go up in value. That part of the presentation, which I'm sure you all appreciate, we want to carry on with at least until we get above the parity level of 100,000. This notional 100,000 invested in the middle of February, where is it at now? Again, as I've said a couple of times today, funds seems to be going sideways, markets are going up and down, but not too much volatility in there. So I'm pleased to show you there what the figures are right now. They're virtually neck and neck, the risk score 2 and the risk score 3 portfolio. So that shows as well that the risky assets, the stocks which fell the most, so the orange line, which is the risk score 3, clearly fell the most going into March. That's now back. It keeps trying to get ahead of the risk score 2 portfolio, which has more government and corporate bonds in there, but it is kind of neck and neck right now. So from the high point in February when it was 100,000, the risk score 2 portfolio is currently negative minus 2.16, and the risk score 3 portfolio minus 2.11. So almost no difference in there. And again, for the clients who are coming in right now for annual reviews, the actual annual growth that you're seeing from the 17th of July to the 17th of July, it's up by around about 0.5% overall. So not really much in it. There's some profit there. Over the 3-year and 5-year figures, we're very pleased that there is good growth in there. And a lot of people are looking at that and saying, well, I've taken so much income out, I've taken these withdrawals, my fund is in a profitable position. Well, that's where a drawdown fund needs to be for those people in drawdown who rely on their pensions in retirement. So again, pleased that we're not sort of seeing sudden declines anymore, but hopefully we continue seeing these increases week on week towards the end of the year. The Royal London funds, which again we're comparing over that same time period as the risk score 2 and 3 from the 18th of February up until yesterday. As I've said in previous presentations, these portfolios are a little bit more cautious, actually less in overseas stocks and shares, more UK focused. The government portfolio 5, which is the pre-retirement one for most people, is minus 5.8. Since the end of February, but the government retirement income portfolio 3 and 4, which is the drawdown portfolios for those people taking income, as you can see, the government portfolio, retirement income portfolio 3 is minus 3.5%. That one has more in government bonds, so when the markets collapsed, it didn't go down as much. And the government retirement income portfolio 4 is minus 5.2%. I mentioned there that we had a discussion with T. Rowe Price at the beginning of the week. We have another update with Royal London's main fund manager in the next 2 weeks. As soon as we have an update from what they've got to say, then we'll certainly share that for you. But no concerns with anything going on there. As I say, they're doing what they say on the tin. Very cautious portfolios, very cautiously managed. As I say, hopefully they'll continue to recover as the year continues as well. So thanks again for listening to Wealth of Advice Update. We've said all the way through the crisis that we would continue to do these updates as enough people continue to watch them. Whilst there is still enough people watching them, we've decided that we're now going to present these on a fortnightly basis, simply because the amount of stories that we're talking about are reducing. There's not as many dramatic events happening on a daily basis. So we just feel it'll be more worthwhile if we send these out every fortnight. We do intend to increase the amount of online content, the amount of digital stuff that we're sharing with people and clients in the coming months, and we'd welcome any feedback you have on all of that. So thanks again for listening. Have a good weekend.